Have you ever wondered why some people are rich and others are poor? What makes the difference between someone who always has plenty of money to live on and someone who works 2 jobs and lives paycheck to paycheck? It may be that most of us don't know how to handle our money properly. There are techniques, however, that we can use to increase our wealth over time even if we make less money than we spend. One great way to build your wealth over time is called dollar cost averaging. It's actually so simple that you can do it even if you're not financially savvy. Dollar cost averaging is a simple but effective investing strategy that allows you to buy more of an investment when its price is low and less when its price is high. In doing so, you'll minimize risk because you're buying into a security at regular intervals, regardless of whether it's been rising or falling in value. As a result, your average cost per share will be lower than if you had made one lump sum purchase. If prices continue to fall after you've purchased shares, you'll end up with more shares for your money. And if prices rise after you've bought shares, then any new purchases will have a lower average cost than your initial investment. So what does dollar cost averaging have to do with getting rich? By regularly contributing money to investments instead of making lump sum purchases, dollar cost averaging can help reduce market volatility, and therefore risk in your portfolio over time. It also makes rebalancing easier. Simply put, rebalancing means ensuring that your portfolio has a proper mix of stocks and bonds by bringing holdings back into line with their target weights. For example, say you initially invest $10,000 equally in 3 funds: a large cap growth fund with 70% allocation, small cap growth fund with 20%, and short-term bond fund with 10%. Over time, say 2 years later, those funds have performed as follows. Your large cap has increased 20%, your small cap has increased 30%, and your short bond has increased 5%. At first glance, these results look great, but they're not really. Your original 70-20-10 allocation was supposed to remain intact throughout these 2 years. However, since your large cap growth fund has rose 20%, it now represents 80% of your portfolio, while both your small cap and short-term bond funds are only 10%. This isn't ideal because we want our portfolios to remain diversified across different asset classes. To fix things, we'll simply sell some of our large cap funds and use that money to buy some more small cap and short-term bond funds until all 3 are once again equal parts. This process is called rebalancing. Some investors dislike dollar cost averaging because they can't wait for their money to grow. But Ron McCoy, CEO of Freedom Capital Advisors in Clermont, Florida, says that type of attitude can make it tough to achieve long-term success. It's important that you keep your emotions in check when investing, he said. If you don't do that, then chances are high that your investments will perform like a roller coaster ride and end up nowhere fast. Most people have no discipline with dollar cost averaging. They'll put in $1,000 one month and nothing on another month or vice versa. Well, there's nothing wrong with taking your time or being sporadic about putting your money into an investment account as long as you're consistent about buying regularly over time. It's not that big of a deal if you miss 2 months, McCoy said. You'll just have to pick back up where you left off. But if you miss several months at once, your average price per share may be significantly higher than it would have been had you bought more frequently. You should also look at dollar cost averaging as a way to protect yourself from market volatility. Dollar cost averaging, or DCA, is a way of smoothing out investment risk over time. For example, imagine you have $1,000 and you invested it in company X. After 6 months, that stock crashes and your entire investment vanishes. However, if you had invested just $50 per month instead of all at once, say on the first day of every month, your losses would be far less devastating. You'd still lose half of your money, but now you've got 9 more chances to make up for those losses. This strategy works because when stocks are down, investors tend to buy more shares, driving prices back up. While when stocks are up, they sell off some shares, causing prices to fall. If you're looking for an easy way to get rich, dollar cost averaging is one option worth considering. Dollar cost averaging is a risk mitigation strategy for investors concerned about dramatic movements in equity markets. Since DCA works by investing equal amounts of money at regular intervals, it helps to minimize investors' emotions and preserve market value when investments are sold. DCA is more psychological than strategic because investors need not worry about dramatic market movements. It can be used by both conservative and aggressive investors as well as by individuals with long or short-term investment horizons. If you use dollar cost averaging consistently, your portfolio will benefit from less extreme highs and lows caused by market volatility. In addition, because DCA spreads investments out over time, it gives a bigger payoff if interest rates rise. You don't have to invest an entire lump sum at once, rather invest small sums on a consistent basis so that you buy fewer shares when prices are high and more shares when prices are low. This approach helps reduce overall investment risk, says CJ Brott of Capital Ideas, a registered investment advisor in Dallas. It's a very simple way to address risk through diversification and rebalancing in a very mechanical way, which is probably why it has grown in popularity since its inception. Simply put, instead of attempting to make big-time market predictions or trying to time economic cycles and falling, investors using dollar cost averaging make regular contributions of equal amounts into investments they believe will be profitable over time. What makes an investor think that their prediction outcome will come true? They don't know for sure, but with careful research and monitoring of historical trends, there is potential for success with this strategy. Why does DCA work? One reason DCA works is because it takes advantage of ups and downs in prices. When markets are low, new investments can be purchased at lower prices than originally planned for. In addition, as markets rise, new purchases can still take place at lower prices than before. Because DCA spreads out your buying over time, you won't feel as much pain from any single dip in stock prices. It also makes it easier for you to recover from temporary losses in value. So whether you choose to invest via DCA or not, remember that investing in stocks involves risk, and dollar cost averaging is one way to manage that risk. When you make regular contributions to a mutual fund or exchange-traded fund ETF, for example, your money is automatically invested at regular intervals, say $100 every month, into shares of that fund. This helps you avoid trying to time when you buy and sell, which can be difficult and expensive. Instead, you get into the habit of contributing regularly so that it becomes part of your monthly budget. It's also easy to automate investing through an employer's 401k plan, or through an online brokerage account with set-up recurring purchases. While it's good to have some financial freedom from worrying about how your investments are doing, that doesn't mean you should just ignore them altogether. To manage risk, diversify your portfolio by spreading money across different types of assets, such as stocks, bonds, and cash equivalents like CDs and money market funds. And remember to rebalance periodically to maintain a mix that matches your risk tolerance. Dollar cost averaging overcomes emotions by taking emotion out of investing. Using dollar cost averaging involves two steps. 1. As money is received, buy a fixed dollar amount of a particular investment on a regular schedule. And 2. Regardless of whether prices have gone up or down in between purchases, don't make any adjustments to your predetermined schedule. This approach avoids behavior-based decision-making and allows you to be disciplined with long-term strategy. While you're young, it can be difficult to get started saving for retirement. With student loans and car payments, you may not have much left over at the end of the month. But with DCA, you don't need a lot of spare cash lying around to begin accumulating wealth. Dollar cost averaging is a simple strategy that lets you invest small amounts on a regular basis. You'll never buy all your stocks or bonds at once. Instead, you invest small amounts over time to avoid timing market moves perfectly, which is impossible. In short, dollar cost averaging is an easy way to build wealth slowly but surely. And if you keep investing regularly even when markets are down, DCA helps you minimize your risk. It's one of those set it and forget it strategies that will help you ensure you won't run out of money in retirement. Plus, since most people are bad at saving consistently, dollar cost averaging makes it easy to build up a nice nest egg without having to think about investing very often. Well, that's it for today's video. Please tell us your thoughts about DCA in the comments section. We'd love to hear them. And as always guys, don't forget to subscribe and give us a huge thumbs up. Thanks for watching, and we'll see you at the next one.